Hey there, welcome to the channel. Hey, today I want to talk about a little bit about inflation. I was listening to the Uneducated Economist, and he was talking about this interview on Macro Voices with Jeff Schneider. And, definitely do like the guy's channel. You should really check it out. But one of the main things that he was talking about and was the talk about how almost like this is not inflation or because because basically the idea is that inflation is always a monetary event, and that's not what's happening right now. What's happening right now is that there's supply shocks and things like that due to supply chain issues, et cetera, and that kind of a thing. So my view on this, and let me go share a different screen here, is that one of the things is like there's a lot of you can look at the details, and in a lot of these people that you hear, they're actually very advanced, much more advanced than me for sure, and they do have like very detailed focus on and knowledge of many of these markets. And so what happens is they I think what's happening is they tend to kind of focus on the details. I mean, if you deal with the bond market and you're a bond trader, or something in the financial markets, you're watching that every day, and when you look at interest rates and you're like, well, low interest rates are tight, tight credit, et cetera, and all these different things. Like, I mean, I can't say. I mean, that certainly could be the case, but the thing is, for the average Joe and Jane out there, for us, you know, we can only, like, if you're not going to be day trading the bond market, or get a Bloomberg terminal and get all that detailed information, we have to kind of like maybe simplify it. So that's kind of where my view comes from. My view is like, hey, are we getting into the weeds here, and are we losing sight of really the big picture of inflation? Okay, so if we look at one of the charts that I like to look at, is you can go to Fred, which is a St. Louis Fed. Really, I know there's a lot of criticism of the Federal Reserve, but this is one of the banks. There's whatever 12 regional banks, and this one is known for their data collection. So it's really good. It is a good resource, and I would recommend that you check it out. If we look here at the consumer price index, so here this is all urban consumers, all items, US city average. And what this is based on their methodology. They'll take a group of products and services and whatever, and they'll measure the price on it. And so this is on a monthly basis. And then when you hear that inflation went up 5% year on year, that would be comparing from, for example, if it was 1990, and you compare the cost of that basket of goods from a year ago, and it said it went up by 5%, and the inflation rate is 5%, that's what that means. So that meant that if, for example, it costs you $100 to buy that basket of goods a year ago, and now you had 5% inflation, they would cost you $105. And all other things being considered, because if you notice that the index, they kind of base it at this period of time at 100, 1982 to 84, 100. And so what happens is, so basically, if it costs you $100 to buy those goods a year ago, inflation was up 5%, then that means it costs you $105 to buy those goods now. If we had deflation and let's say it went down 5%, then it would only cost you $95. So that's the idea behind it. And in this particular chart is interesting because it's just showing basically the price of that basket of goods. And so it's not giving it in percent. It's just showing the cost of that. So if we go back into the 50s, we can see that it's not moving very much. Just look at the curve. We can really look at it in terms of a qualitative thing, just kind of visually look at it. You can see it's not moving very much. You can see here in the 70s that the slope of the curve started increasing. In this, period of time from 72, we went off the gold standard. That's when this really started going up, and inflation started going up. So once again, the cost of those goods are moving up. And if you look at it like So now in the big picture for the average person who's not day trading the bond market and running money for people, what do you see on this chart? It's very important to just like sometimes just look at it very simply. What do you see? What is happening to the price of goods? Do we have an inflationary environment going back to the 50s, going back to the 70s? Is it an inflationary environment or a de-inflation environment? It's clearly inflationary. The price is always going up. So just so we understand, if we were in a deflationary environment, you would see something else. You would see that curve going down over time, the cost of those goods going down. But that is not what we have, clearly, right? Now, what we have is we have moments in time here, which was kind of the financial crisis. And then over here, this cerveza sickness. We had these little moments where it went down. So this is kind of an interesting thing. What happens is that I think people look at it and they say, well, this was a deflationary event or whatever. Well, this was a deflationary event. What we had happened here in the financial crisis, and then over here again at the start of the original lockdowns from the financial, but it didn't last very long. So my point is that, yes, we have inflation. Are we going to have these dips in the future? Sure. Are we going to have prices in certain things go down and the rate of inflation slack off? I bet for sure. Like you can't have used car prices go up 10% per year forever. It's very unlikely. It's very unlikely. That's going to slack off, and you might even have negative prints and stuff like that. But the overall scheme is that you're in a price environment. So now look at it in a practical sense. Look at it in a practical sense. I have been both, a renter, a homeowner, and then gone back to being a renter again, and then a homeowner again. And if you look at this chart, this is also the chart of housing in much of the country. Now, this is a much steeper chart that there's large parts of the country where housing doesn't go up at this rate. It goes up at a much slower rate. But other parts where I'm in California, that's like what I would call a high beta market. When the prices are going up, they're going up. And, it's not uncommon to see 10%, 20% appreciation at times. But then when the market corrects, it's like, boop, you're going to get a correction, right? So the point is, what is the consequence of this curve? What really is the consequence? The consequence is that, this is also a reflection of the rents going up, of the housing costs going up. So basically, you want to ride this curve. You don't want to be betting on deflation. You don't want to be betting on these things in the big picture, right? The biggest item for most people is their housing. Your rent, like it's very disturbing because there's a lot of people that are paying more than 50% of what they make on housing. And that's very unsustainable. They're the future homeless, right? Because one thing goes wrong, they may still have their job and they're going to be in trouble. So you want to play with the curve. And I am not giving financial advice. That's not what I'm doing. I'm just saying that's what I do is I've learned the hard way that, hey, man, you got to play with the curve. We are in an inflationary environment. We continue and we will continue to be. We will have bouts of deflation for sure. But, in the big picture, wait a year, you're going to be back to prices increasing. That's just what it is. Look at the chart. That's the data. That's what you have. Now you can go back and you can look at the M2 money supply. So M2 is a good one to look at. If you study basic economics, they break up the money supply into the most liquid is like your M0, and then you have your M1 includes other stuff, and then M2 might include bank accounts and blah, 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 and other stuff. And you can read all about that, but this is a good measure because they are giving it to you. One of the things is they used to measure the M3 and they're not giving us that anymore. So looking at the M2, we can see that this has also been increasing over time. Now, is this directly correlated to the CPI? Probably. I mean, look at the charts. You just kind of look at the charts you want to look at it like a grade school child. Well, if this chart's going up and this represents the amount of money that's out there that's being created by by the government, the banks. This is stuff that's created. We have the Fed doing its thing. Depending on what the Fed do, it affects what the banks do. The banks generally create the money. You get a loan, that money isn't taken generally from something that's there. It's created out of nowhere. And that's how money's created. right? And there's many places you can go look to see how that works. So here we are now. So now I'm going to go kind of zoom into the more recent time frame. This was the Cerveza thing. And look at this massive increase. It turns out this is like a 25% increase in the money supply in 1 year when you do a year over year on that. So you increase the money supply by 25%. You already have a slope of increasing money supply before that, and now the slope on the back end, even with like right now they've cut a lot of the benefits and a lot of that stuff, we still have the money supply is still on a steeper slope. If you look at that, then this CPI chart makes perfect sense, right? This is continuing to go up, and if you kind of notice here, and you may not notice and may not be able to really see it, the slope on this slope is actually very steep. You know, this slope is becoming on a much steeper angle, and it's kind of like the curve is going from more linear type curve to like it's almost starting to have a little bit of an exponential to it. So this is the big environment that we're in. So when I think, you know, the thing that I consider is I listen to all these experts, and you got the George Gammon out there too, and they talk about deflationary this and that, and I always like to look at the big picture. The big picture is, from my perspective, my thing is I bet on inflation. All the charts for the last, since before I was born in the 60s, before I was born, money supply has been increasing. What's going to change that? Nothing. CPI has been increasing the whole time. Nothing's going to change that, you know? And so that's the big picture. And you can see that because like when you buy a house, like before I owned a house, it was like, oh, really hard to save money, and you couldn't save money. And even after a house, you can't really save money. But when you go to sell a house and you suddenly like, wow, there's a bunch of money sitting there. Why? Why is the money sitting in there? Because you're on this curve. Now you're on the ownership side of it, the asset side. So the price, and then if you get 30-year fixed debt, your payment is pretty well fixed. Now, yes, you're going to have to pay for, you're going to have to, you know, pay property taxes, maintenance, all that stuff. But generally that's on the lower side compared to this inflation curve. So, you know, then when you go to sell it, you realize like, oh, you're pushing up against the wall of like, you know, the free 250,000 per person capital gains that you get the freebie, and 500,000 per marriage. You start like getting over that when you're selling, depending where you are and how long you've held the place, you kind of realize that that's the way you want to bet. And the problem that you have is, see, when you do 30-year fixed debt and you're owning your home, which is a liability. So it's important to understand, I'm fully on board with the Robert Kiyosaki. He is right. It is a liability. But the problem that I have is like, look, I'm on this trend. If I'm renting, then I'm on the other side of it. I'm losing because my rent is going up. And I saw this as well. Like they have to raise the rent. If you're renting at a bigger place, like every year, like $50, another $50. And next thing you know, you live at a place for a couple of years and you're like, wow, man, it's like my rent's like I was living in San Diego and it starts out at somewhere $950 a month. Next thing you know, you're at $1,000 a month and you're like, wow, it's really squeezing you, right? Because like I'm not getting a raise to like that matches that. So that's really the point of this video. The point of it is that try to, from my perspective, I'm sharing my perspective, keeping on the big picture. The big picture, it's always inflation. Any little dip, and also and the percentage, like in here, they're like 1%, 0.5%, 1/4%, whatever it is. Sometimes you'll see, oh, there's a little deflation, and then they freak out. But overall, even like in here, a lot of the CPI reports were probably like, you know, oh, 0.2% or 1%, and no one notices, no one cares, right? And that's fine, and that's all good, but it's always going up. So, you know, you have to figure that out, and that's what you have to figure out, is how to be on the side of inflation. So the question really is, what things inflate? Now, you know, normally your stocks, your housing, all that stuff tends to inflate, even though the problem is when you have these little, you know, deflationary glitches, you could have problems. And then the other comment I wanted to make was, particularly Mr. Snyder was talking about how the bond market is not showing right now because the interest rates are not that high. I mean, we have definitely kept under, we had that spike and we've gotten up to, you know, 1.7%, something like that. And we still haven't broken that, We are well under, we're under 2%, and we're really, whether we're at risk or not of going above 2%, it's just not there. We're not there. Now, here's the problem. On one hand, you take charts and you go back to the 50s. You go back, which is really good. You go back, I'm going back 100, you go back 100 years and you're looking at stuff because you're trying to understand, hey, how does this work? That's a great thing to do. But we have to factor in that things changed. When you look at the inflations that occurred in the 60s, 70s, 80s, even stuff in the 90s, it was only after the financial crisis that they started this quantitative easing. It was only after that that they really started these massive bond buying programs. So you have to understand that, and you have to take that into account. So when you look at the bond market and you say the bond market, and I will just show that right here. I will go here just a minute. Right. And so here now we're looking at the 10-year Treasury yield. We're looking at a weekly chart. So we're looking at 2 years of data. And you look at this chart and you say to yourself, well, hey, the bond market is not detecting inflation. If it was, then these rates would be much higher. That's what some people maintain. But you have to understand that that's in an environment for years where this is the Fed, and this is where they're talking about their plans to buy their purchases of securities. So here they are, they're out there buying $80 billion a month. And I don't know what these are. These are Treasury purchases or Treasury and mortgage-backed securities. I don't know which one it is. But in essence, it doesn't matter, right? Because you have a bond market, and the bond market has many parts of it. You have the Treasury type market, you have the corporate bond market, you have the mortgage market. It may not really matter. They can go into the mortgage market. We're buying mortgage-backed securities, or we're buying treasuries. Either one, it leaves money for the others, right? And so the point is, we've had this for a very long time. I just happened to find this page, 80 billion per month. This is every month, $80 billion they're buying. So the fundamental point is that if the argument is that there isn't inflation right now, that this is just a temporary supply shock, whatever, and it's not real inflation because it's not monetary, that to me is wrong. It's wrong because, number one, we had the monetary increase. This was the monetary inflation. Just because it didn't show up in CPI yet, to think that it shows up immediately, we know that's not true. We know that, yeah, the money was already printed, the money was already created, and it took a year to show up, or a year and a half or 2 years. That's pretty typical. That's perfectly reasonable to expect that it takes time to show up. So it is inflation. It is for sure inflation. Now, and once again, factoring in the bonds at 80 billion a month, you're talking like 80 billion a month. Well, then this market, you're looking to the bond market to say that, oh, it doesn't think it's inflation because rates are low. Well, of course, that's because of the money being poured in by the Fed, poured in to keep these rates down. So big picture, let's not lose sight of the big picture. We've been in an inflationary environment since I was born. Literally. So don't lose sight of that. So when you're playing games, you got to kind of just take that into account. All right, that's it for this one. Talk to you later.